Bitcoin represents ideal capital. It represents engineered capital. It represents digital capital. And it was created, as you know, by putting together a set of technologies: proof of work, public key cryptography, peer-to-peer networking, distributed time stamping. And by putting together a set of components that had been around, Satoshi was able to create an ideal capital asset, an asset that's non-sovereign store of value, bearer instrument without counterparty risk.
Bitcoin isn't just another asset. Saylor is framing it as perfect capital. No counterparty risk, no central control. If you want more breakdowns like this, subscribe. This is where Bitcoin gets explained properly.
They have immediate bills to pay, and they want that cash flow now. And so our company's strategy converts capital into credit. We take the BTC commodity and we convert it into a currency, like the US dollar or the euro, with Stretchit's USD. We take the risk that's 1-for-1, and then we over-collateralize to strip it away. If you collateralize something 5-to-1, that means that the capital asset can fall 80%, and you're still fully collateralized. So the capital investor has lost 80% of their collateral. The credit investor is still protected. So you're stripping risk. When you do that, you damp volatility. The volatility of Bitcoin's been 40. We strip that volatility away when we strip the risk away by targeting a standard value. And from that, you extract a yield, a cash flow.
This is the core idea. Bitcoin is volatile but powerful. Saylor is turning it into something that behaves like a high-yield savings account.
Digital credit appeals to people that might like private credit. Private credit is the reach for yield. People that don't like money markets, they don't like investment grade bonds or junk bonds, they buy private credit. There's $3.5 or more trillion in private credit. But private credit's illiquid, it's opaque, it's heterogeneous. It's a portfolio of 1,000 private loans. It's discrete, it's restricted to qualified investors. There's a high fee associated with it. And we just saw in the past month that private credit markets have been melting down. They got hit with a rash of redemptions. They couldn't meet their redemptions. And yet it's $3.5 trillion of money that wants to invest in these instruments. Digital credit, it's liquid, it's transparent, it's homogeneous, it's scalable, it's accessible to everybody, and there's no fee.
This is one of the most important insights. Yield doesn't come from nowhere, it comes from Bitcoin's performance.
Well, you start with the performance of asset classes, and if you look at the performance of Bitcoin over the last 5 years, it's up 38% a year, which is much better than gold or the S&P. Real estate's up 6% a year. Money markets are up 3% a year. You can't create a credit instrument that pays a dividend higher than the capital return of the capital that the credit's being invested in. So as you can see, the theoretical highest yield you could ever pay on gold-backed credit would be 16%. The theoretical highest yield you can pay on real estate credit is 6%. On the other hand, with Bitcoin, the theoretical yield is 38%. So if you think about the theory of asset-backed credit or the theory of digital credit, what you do is you take the capital gain you expect in the capital asset, and then you pay a portion of it to the credit investor. If you expect 30% in Bitcoin, you could pay 11% to the credit investor. The excess yield, in this case, the 19% yield spread between 30 and 11, that goes to the equity.
This is one of the most important insights. Yield doesn't come from nowhere, it comes from Bitcoin's performance.
Digital credit simply strips the first 11%, you return it to the credit investor, and you get a very comfortable ride. Now, if you look at that chart, you see we're just doing signal processing on a financial signal. Where does the excess volatility go? Where does the excess return go? It goes to the equity. And so We created digital credit off of digital capital, and then that creates digital equity. As it turns out, all three of these assets are created with digital intelligence. We couldn't create digital credit without digital intelligence. So if you're looking for a killer application of AI, it's taking digital intelligence and working on digital assets or digital capital to create digital equity and digital credit. And you can see it at work here. In fact, we've done it with our own securities. So now, if you think about how this sits for an investor, if your time horizon is less than 4 years, if you need the money in a month or a quarter or a year, you probably want to hold the credit because you don't want any volatility in the principal.
This is great because it expands your audience beyond maxes, makes the system feel complete.
STRC isn't just the biggest preferred, it's actually the most liquid preferred in the world in 8 months. Let me say that again, in the world, it's the most liquid one. It's not even 12 months old. Look who it's competing against. Wells Fargo, Bank of America, Fannie Mae, Citi, JP Morgan. It's 25x more than the next best one, and it's not a year old, right? It's like Superman as a toddler beating the crap out of everybody. Bitcoin peaked in October 6th. It was 125,000 a coin. It's 38% down. STRC is 0%. It's exactly held par.
This is the emotional selling point. What if you could get Bitcoin upside without the pain?
And we come up with something which pays 11.5% that's tax deferred, that's liquid, that's transparent. If you're a taxpayer in Miami Beach, that's the equivalent to a bank account that pays you 18%. Now what you see is we've created the short end of the yield curve, like the 1-month Bitcoin bond, the risk-free rate in the crypto ecosystem. You walk down the street and ask 100 people, do you want a 30-year bond? Do you want something you got to hold for a decade and see if you get wealthy on it? Or do you want a bank account that pays you 10%? And the answer is everybody wants a bank account that pays them 10%. Some people that are specialists might think they can do better than that with some of their money, but every corporation, every individual, every institution has a lot of money they want to put in a bank, preserve the principal, and they want to get paid 3 times the money market rate. Every dollar that goes into digital credit will flow into digital capital. It will flow into the Bitcoin network. And as it flows in the Bitcoin network, the price of Bitcoin should increase. We expect that digital credit will drive the size of the Bitcoin network. And what's the end game? The end game isn't that complicated. It's give a bank account, an 8 to 10% a year yielding high yield digital bank account to 1 billion people. Drive Bitcoin to $10 million a coin. And make Bitcoin a $200 trillion network until it grows higher.
This is the big vision, not just yield, not just finance. Complete transformation of global capital markets. Let me know in the comments. Do you think this actually works, or is this too good to be true? And if you want more breakdowns like this, hit like and subscribe. It really helps push this content out.